The first thing I would say is I don't trade the technology stocks because I don't do things I don't understand. And I don't have enough of an ability in technology, as you well know, that I think I have any durable competitive advantage in technology. I will say, off the top of my head, that if technology falls by 25% in price, it is to me 25% more attractive, not knowing anything about the value. The meme stocks, I frankly never understood. The big ideas sort of stocks, I don't know how you value an idea. So I had no intention of participating in that market. I did notice in the broad market that as breadth became narrower and narrower, the billion-dollar market cap companies and the $500 million market companies became relatively cheaper at the same time that the market was going up. I didn't participate in that because my nervousness was that the broad market was going up simply as a consequence of low interest rates, higher capitalized value of distributions and lower cost of capital. And I was concerned about making a bet that focused on the continuation of unrealistically low interest rates. But I noticed, as an example, that a few household words, Berkshire Hathaway among them, is now trading at an 8.6% earnings yield. Okay, pardon me, 8.6 times earnings, 12% earnings yield. Okay, I have a sense of humor for that, particularly when there's $180 billion in cash that's earning them 50 basis points. That's not unattractive to me. So I'm starting to see some glimmers of hope in the broad market. At the same time, probably not coincidentally, that the narrative is souring. With regards to inflation, I think that the writing has been on the wall with regards to inflation for a fairly long time. But what we're seeing now is that the demand constraint that COVID put on the broad economy is beginning to fade away. And the consequence of that is that the true nature of inflation is beginning to show itself in consumer prices, which is normally the last place it shows itself. The producer price index has been strong for some period of time. And we've noted, too, the deterioration of faith in the dollar in various markets. But a circumstance where headline inflation is variously estimated by the government, not by me, at between 6.5% and 7.5% reminds me of nothing so much as the situation that occurred in 1968. At that point in time, the writing had been on the wall with regard to inflation, and we began to experience inflation, but the consuming public paid no attention to it because it hadn't been a threat for the 20 preceding years. I think we're right there, Albert. People understand that inflation's back, but they don't understand how it bites you. When people begin to get bitten by inflation, truly bitten by inflation, then I think the attitudes of savers, investors, speculators, and even voters will change. I think we're on the cusp of that. For anyone with a pulse and a decent FICO score. And in addition to that, while we are beginning to see corporate balance sheets take on debt, we see massive amounts of cash in corporate America. And among the individual investors that I talk to, the liquidity in the form of cash is truly staggering. While I'm concerned about many aspects of the market, and I'm concerned about many aspects of the economy, to the extent that there isn't a change in the near term with regards to confidence, there is so much cash in every part of the system that the liquidity you describe as driving the markets is likely to continue for a while. I'm hoping that the liquidity does find a new home. I'm hoping that investors who have been schooled by 40 years of good markets lose a bit of their hubris. In other words, I hope that fear returns to the market a little bit. Maybe I should substitute the phrase common sense for fear, but the discussions that I have with individual investors, and I have lots of them now that I'm retired, tell me that most individual investors still have too much confidence. Most of them are still making decisions based on their experience in the immediate past. Most of them, when I explain that we have lived through the most benign 40 years of economic climate that the world has ever seen, a period of declining interest rates, a period of increasing productivity from technology, a period where the demographic age of the baby boomers was around, a period at least from the period 1980 to 1995, but perhaps 2000, where the growth of government was constrained. Government didn't fall, but the growth of government was constrained. A period in time where globalism and world trade increased, and a period of time when women entered the labor force, and a period of time, too, when emerging and frontier markets actually emerged. If you think about all the tailwinds that the economy had for the last 40 years, you'll understand something about investors' optimism. I would suggest to you that economic nationalism is beginning to replace free trade and globalism. I would argue, too, that the demographic boost offered up in Western countries by the baby boom is over. We're dying. We're not maturing. I would argue, too, that a period of 40 years that saw interest rates decline in the U.S. 10-year Treasury, as an example, from 15.5 all the way down to 1 before coming back up to 2, suggests that the tailwinds that we got from declining interest rates is over. In other words, I suggest that there's, in effect, an epoch change. It doesn't mean that the future is going to be bad. It just means the future is going to be different. And I don't think investors have made that shift because I think investors' perceptions are still set by their experience in the immediate past rather than by history. I own a treasury ETF called BILL in very short-term treasuries because I personally have more liquidity than I'm used to. I don't own the U.S. 10-year because I don't own any long debt. But if you, Albert, the idea that I should trade bonds for capital gains and rely on stocks, dividends for income, flies in the face of everything that I've learned in 50 years as an investor, and I'm not going to play the game. The arithmetic around the 10-year Treasury is lunacy. The only thing I can say for it is that the government absolutely promises to pay you, and they will. Who knows what they'll pay you with? They may print it up, they may conjure it, but they will pay you. That's the U.S. 10-year Treasury's sole remaining grace. But if you look at the arithmetic, even at the interest rate that prevailed 10 days ago, which was about 2%, the government promises to pay you 2% in a currency where they acknowledge that your purchasing power is declining by 6.5% or 7%. The attractiveness of that is a simple arithmetic function. You take 2% and you subtract 7.5 from it, or if you want to be more conservative, 6.5. The government is guaranteeing that they will make you less wealthy by 4% compounded over 10 years. My friend Jim Grant calls that return-free risk. Why would I do that, Albert? Why would I forego consumption in favor of someone else's consumption for 10 years, take credit risk, and then agree to be paid back less than I had paid them? This is true lunacy. People are saying, well, they could easily cut the interest rate from 2% to 1%, in which case you'd have a capital gain in the bond. I don't trade narrative in return for safety and yield. I don't speculate in bonds. Bonds for me are for security of income and security of principal. And the bond market these days guarantees me that I lose both.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.